Hello, my name is John Zolaitis. I am the founder of Covatus Capital, and I'm going to today give you a presentation that I gave in October this year at the second annual European Value Investing Conference in Athens, Greece. The presentation was in English. First, I want to thank Professor George Athanassakos for inviting me to the presentation. And before we get started, just want to mention my disclosures that Covatus Capital is a registered investment advisor in the state of New York. This video is not an advertisement, and you should seek investment advice from your financial advisor. Lastly, before I want to get going, I just want to mention that the presentation was intended for finance professionals, however, not necessarily those who do stock picking, nor who follow a value investing discipline. So without further ado, what we're going to go for here is I'm going to try to identify 3 sources of error in value investing, which I'm going to introduce via analogies. Then I'm going to spend a decent amount of time going into our process for evaluating stocks, which is intended in part to evade these errors. And lastly, hopefully it will not be totally boring. First conflict or analogy that I want to discuss is the Birmingham Screwdriver. The Birmingham Screwdriver is a attack, if you will, on residents of Birmingham, England, and is making fun of them because a Birmingham screwdriver is in fact a hammer. This kind of suggests that residents there are only using this one tool for all possible tasks. It also suggests sometimes the overuse of force when a more delicate approach would be preferable. In our case, I'm going to call the value investor Birmingham Screwdriver when you overuse valuation filters in stock selection. What do I mean by that? What I mean is if you take PEs, EV/EBITDA, or price to book, and use this as your primary approach when separating stocks that are interesting from those that are not, I believe that this creates a source of error. Instead, I think our approach is to evaluate the businesses by breaking them into different pieces and identifying the true economic drivers within the business. We then conduct a valuation analysis, and we look for a margin of safety after determining the future drivers of cash flow and earnings, which might not be that obvious and therefore would be missed by an easy valuation filter. To clarify this a bit, we're going to go through a company that I've been following since it came public, which is Academy Sports. Academy Sports is $4 billion market cap. It's a sporting good retailer based out of Texas. And if you look at it, even today, it still looks pretty darn cheap. But in my process, we're going to discuss a way to back that up with a more in-depth analysis of the business, which I'm going to go through in a kind of overview. So our approach in this case is to estimate the cash flows from the existing business and then assign a value to those cash flows as if the business were not going to grow into the future. Then we're going to look separately at the part of the business we think is going to be produced by future growth and capital deployment, namely new stores, which are not yet opened. And we're going to estimate the value of those cash flows using a store level DCF, discounted cash flow model. Then we'll take those two pieces together and we'll compare it to what the market is paying for the business. So for Academy, we took the existing EBIT, after-tax EBIT, we added back depreciation, and then we subtracted maintenance CapEx to estimate the cash flow from the business in a steady state, as if it were no longer growing or it wasn't growing at all. In this case, we got that the steady state cash flow was about $8 per share. If we felt that a 12% free cash flow yield was the appropriate way to value this, as if you were going to get $8 every year, it would imply a $67 value for the stock. However, with the stock trading at this time below $50, we estimated that this implied the cash flow was going to decrease 25% from current levels. We then looked at the value of the company's plan to open about 90 stores over the next 5 years. And we calculated each store's individual cash flow over that period, and then discounted back the value of the cash flows of this to be deployed capital. And in this scenario, we believe or estimate that the value of those future stores is about $2.2 billion or $26 per share. So third step here is to, now that we're armed with our two estimates of the value of the existing business and the value of the future stores, which are yet to be opened, we compare that to what the market is paying for it. And at $45, we understand that the market is focused on risk to the existing business, as we discussed earlier. And essentially, we believe that the market is factoring in nothing for the growth of the business. And as a result of this approach, we're very strongly convinced that the stock is materially undervalued relative to the cash flow and earnings that we believe it will produce in the future. Okay, on to our second conflict and analogy. First, which we're going to call the Penrose Heuristic. Now, Roger Penrose is a mathematician. He was awarded by the Nobel Prize in 2020. He's still around. And together with his father, he published in 1958 something called the impossible triangle. If you take a look at this, you might recognize it. It is the basis of some very popular illusions, notably those created by Charles Escher, who was inspired by this particular diagram. And I like the idea that it takes your eye and forces it to follow the triangle around and around. And heuristics are something that I've learned about recently by reading Daniel Kahneman's books. And I think they're important to kind of understand because we use them all the time. A heuristic is a shortcut. It's the substitution of a simple process that generates an approximate answer from a more complicated, more difficult process that would get you to a more precise answer. One of my favorites is the availability heuristic. And that is when you ask how probable is some event, for example, winning the lottery. And so you think to yourself, how easy is it for me to think of an example of somebody who's won the lottery? Thus, how available an example is tells you it's a shortcut, how probable it is to win the lottery. That's a lot easier to do than to actually calculate the odds with data that's available. In the case of value investors, I believe they use a Penrose heuristic when they analyze a stock by comparing it to a similar stock that they already know. So they take this new business, which they've just encountered, and their first frame is to think of some other business that was very similar, and then they either dismiss it or like it immediately or have a bias that's based on this comparison. I think this analysis via comparison is, while it does save some time, is a significant source of error. At least it has been for me. Instead, I think the right approach is to treat every company and every situation as if it were unique. Now, obviously, this takes more time and is more difficult, but this is how you avoid the error of comparison when things are not quite the same. Our approach that we developed at Covatus Capital is to look at businesses from a unit level economic perspective. We talked about that a little bit in the first conflict, but essentially we try to find the real economic drivers, and in so doing, we avoid comparing them very simply to businesses to which they're similar. So the example we're going to use for this one is a company that recently went public. It's called Dutch Brothers Coffee. It has a $6 billion market cap. And if you were just to compare what Dutch Brothers looks like to other businesses, you might say, hey, this looks like an early stage high ROIC compounder. In other words, the next Starbucks. And in fact, a lot of IPOs in the restaurant space over the last 10 years benefited from looking like the next Starbucks or the next Chipotle. And it turns out that there's really just one Starbucks and one Chipotle. However, we have to prove this out through work. And what we did is we calculated the profitability of this business looking at the franchisee revenues and company operated businesses or stores looking to zero in on the return on invested capital that each location was producing for Dutch Brothers. And the reason to do this is as a quality filter. And what we found is that return on invested capital for the Dutch Brothers concept is perfectly fine, but not extraordinary. It's below the average of a group of other public companies and businesses which we've analyzed. We also looked at the factors behind this, and what we saw was that the ratio of how much it costs to open a store to the sales that the store produce is not particularly attractive for Dutch Brothers. They spend a lot on each particular store, and for that reason, the return metrics of the business are just not that wonderful. And now we can conclude, based on this work, that Dutch Brothers is not the exceptional high ROIC compounder, or at least it doesn't appear to be based on the metrics it's producing today. And as a result, we know we should not pay a significant valuation premium for the business based on its return profile. And our third conflict and analogy is around Schrodinger's cat. I apologize if you haven't heard of Schrodinger's cat. Back when I was in high school in Wisconsin, when we finished talking about whether the Packers draft had been good and ran out of discussion of ice fishing, there wasn't much left to discuss. So obviously we want to talk about things like Erwin Schrödinger, who was an Austrian physicist and philosopher. He won the Nobel Prize in 1933. He didn't like cats. It's well known. He created this experiment. Okay, it's a thought experiment where you put a cat into a box together with a poison gas pellet that would be triggered or released by a random event, which we won't get into the mechanism. But what he suggested is that while the box was closed, we wouldn't know if the cat was alive or dead because we didn't know if the poison gas had been released. And therefore, his radical conclusion was that the cat was simultaneously alive and dead until somebody opened the box and observed the kitty, thus collapsing the states into just one reality. And what the idea here which is called the Schrodinger's Cat paradox, the cat's alive and dead at the same time, is that things that are unobserved are existing in these multiple states simultaneously. And it's really a kind of view about uncertainty in the universe. Now, what we're saying is that there is a little known subvariant called the value investor Schrodinger's Cat uncertainty paradox. And this is also about uncertainty. The value investor Schrodinger's Cat subvariant paradox is when value investors conflate uncertainty in the present with uncertainty in the future. And I believe that this is a common source of error because what you hear is that people think the amount of uncertainty in the future can change, and therefore they try to adjust their expectations or valuations or their exposure to the market on this perceived change in uncertainty. In fact, our view is that uncertainty about the future is constant. It's always equally uncertain. But you can see this is a very common thing from these headlines to talk about uncertainty increasing or decreasing. And so therefore, we believe that you should always maintain a similar approach to your capital allocation, your equity analysis, your evaluations, because the uncertainty in the future does not come from what's happening today. It comes from things that are going to happen in the future, which we can't predict, the unknown unknowns. And one further point about this, we think that when we select management teams or investments in businesses, that we are actually deferring our need to manage this uncertainty to those management teams and the business models that they have. So it's not our job as investors, in my opinion, to try to forecast what's going to happen in the future and figure out which businesses are most likely or most capable to manage that. It's rather to find the management teams that are the best and are most able to handle these changes and kind of confer this responsibility to them. So in summary, 3 sources of error we talked about. First one, Birmingham Screwdriver, overuse of valuation screens, and that's a error that allows you to miss really interesting opportunities. The second is the Penrose Heuristic. That is an analysis by similar case, which causes you to incorrectly view companies as either attractive or unattractive based on some similar situation in the past. And the third is the value investor Schrodinger's Cat subvariant paradox, when you conflate what's happening today with uncertainty in the future, which in fact doesn't change. Our approach, on the other hand, is to break businesses into their existing cash flows and future cash flows and compare that to the market value. We also focus on unit level economics, and we try to identify what are the key drivers of particular businesses and how they create value. And we just acknowledge, we try to, that the future is uncertainty, is uncertain. That level of uncertainty is constant. And therefore, we have an investment approach which acknowledges that and is designed to benefit or manage that what might happen in the future that we can't predict. That's it. I hope you enjoyed this. If you have any comments, please leave them below. You can also sign up for our monthly investing letter on our website. And I will see you at the next video. Thank you.